Hello and welcome. This is David Miller, and you're watching Seniors Finance USA. If you have a credit card in your wallet right now, or someone in your family depends on one, I want you to pay very close attention to what I'm about to say, because there is a situation developing right now that could quietly shut off millions of credit cards across America. Not reduce them, not freeze them temporarily, completely shut them off. And the people who will feel it first are seniors, people on fixed incomes, and those already under financial pressure. So before you think this doesn't apply to you, stay with me, because what I'm about to explain could protect you from a financial shock most people won't see coming. Now let's start with what people are hearing and why it sounds like good news. You may have heard about a proposal to cap credit card interest rates at 10%, and on the surface, that sounds like a huge win. Because right now, the average credit card interest rate in the United States is extremely high. In many cases, over 25%. Some cards even go above 30%. So if you're carrying a balance, that interest is costing you real money every single month. Let me give you a simple example. If you have around $8,000 in credit card debt, which is very common, especially among retirees, you could be paying over $2,000 a year in interest alone. That's roughly $180 every single month. And that money isn't reducing your balance, it's just the cost of carrying that debt. So naturally, when people hear 10% interest cap, it feels like relief. It feels like help. It feels like someone is finally stepping in to protect consumers. But here's where things start to change. Because what sounds good on the surface can create a completely different reaction behind the scenes. Credit card companies are not public services. They are private businesses. And like any business, they operate on profit. Now, this is important. So stay with me. When a bank gives someone a credit card, they are taking a risk. Some people pay on time, some people don't. And that risk is measured using your credit score. If you have a high credit score, the bank sees you as low risk. If your score is lower, the risk increases. Now, to balance that risk, banks charge different interest rates. Higher risk, higher interest, lower risk, lower interest. That's how the system has always worked. Now imagine what happens if the government steps in and says, no matter what the risk is, you can only charge 10%. At that point, the math changes completely, because for many borrowers, especially those with lower credit scores, the risk of default is higher than the profit from 10% interest, which means the bank loses money. Not sometimes, every time. And when a business knows it will lose money, it doesn't continue the transaction, it stops it. And in this case, that means closing credit card accounts. Now, I want you to think about this carefully, because this is where most people misunderstand what's happening. This is not about punishment. This is not about politics. This is about math. If a bank cannot profit from lending, it will not lend. That's the reality. And according to industry analysis, if policies like this move forward, we could see tens of millions of credit card accounts affected. Some estimates go even higher. Now here's the part that matters most. Who gets affected first? Not people with perfect credit, not people with high income. The impact starts with people in the middle, people on the edge, and especially seniors. Now let's talk about why. Because for many seniors, a credit card is not just a convenience. It's not just for shopping. It's a backup plan. It's what covers the gap between income and expenses. Let's say your Social Security payment comes in once a month, but your expenses don't wait, utilities don't wait, groceries don't wait, medical needs don't wait. So sometimes people use a credit card to bridge that gap. Now imagine that option disappears. No warning, no replacement, just gone. That creates immediate pressure, but it doesn't stop there. Because when a credit card account is closed, there's another effect that most people don't realize, and this is critical. Your credit score can drop, and it can drop quickly. Let me explain this in the simplest way possible. Your credit score depends heavily on how much credit you have available, compared to how much you're using. This is called utilization. So if you have $20,000 in available credit, and you're using $6,000, you're at about 30%. That's considered okay. But now imagine one of your cards gets closed, and your available credit drops to $12,000, but your balance stays at $6,000. Now your utilization jumps to 50%. And that alone can lower your score significantly. Now, once your score drops, everything becomes harder. Loans become more expensive, insurance rates can increase, even renting a home becomes more difficult. So, one account closure can trigger a chain reaction, and this is how financial stress builds quietly, step by step. Now, at the same time, there's another change being discussed. That could impact the benefits many people rely on. Rewards, cashback, points. Those small percentages you earn when you spend. For many people, that might seem small, but for seniors, that can add up to hundreds of dollars a year. And that matters, because when you're on a fixed income, every dollar matters. Now imagine this scenario. Some people lose their credit cards completely. Others keep their cards, but lose the rewards. Either way, the system becomes tighter, less flexible, more restrictive. Now let me pause here for a second, because this is important. This is not about fear. This is about awareness, and more importantly, preparation. Because regardless of what happens next, there are simple steps you can take right now to protect yourself. First, check your credit score. Don't delay this, because your score determines your position. If your score is strong, you have options. If it's borderline, you need to act early. Second, reduce your balances where possible. Even small changes help. Lower balances mean lower risk, and lower risk means better stability. Third, do not close any credit cards, even if you don't use them. Keeping them open supports your credit profile. Fourth, start building even a small financial cushion. It doesn't need to be large. Even a small amount gives you control and reduces dependence on credit. And finally, stay alert, because whenever financial changes happen, scammers follow immediately. If you receive calls, messages, or emails asking for urgent action, stop. Verify directly with your bank. Never act under pressure, because pressure is exactly what scammers use. Now here's the bottom line. Changes like this don't happen overnight, but when they do happen, they happen fast. And the people who prepare early are always in the strongest position. So don't ignore this. Don't assume it won't affect you. Take action now, while you still can. And if this video helped you understand something important, share it with someone who needs to see it. Because millions of people are unaware of what's happening, and awareness is the first step to protection. Subscribe for more updates like this, because throughout this year, things are changing quickly. And staying informed may be one of the most valuable decisions you make.